Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Longyuan Power Group Corporation Limited, latest report. China Longyuan Power Group Corporation Limited is a leading provider of new energy power generation services. The company operates in several countries, including the Chinese mainland, Canada, South Africa, and Ukraine. Its business scope encompasses various sectors such as renewable energy production. The company's primary focus is on generating power from new energy sources. This includes wind power, solar power, and other forms of clean energy. China Longyuan Power Group Corporation Limited has established itself as a major player in the global renewable energy market through its extensive network of subsidiaries and affiliates. In addition to its core business of power generation, the company also provides related services such as engineering, procurement, and construction, EPC services for new energy projects. This enables it to offer comprehensive solutions to clients seeking to develop and operate new energy facilities. Overall, China Longyuan Power Group Corporation Limited is a diversified energy company with a strong presence in the global market. Its commitment to renewable energy sources has positioned it as a leader in the industry, driving growth and innovation through its various business segments. China Longyuan Power Group Corporation Limited market capitalization of 56 billion is significantly larger than the average industry peer of roughly 3 billion. This shows that China Longyuan Power Group Corporation Limited holds a significant advantage in their industry. China Longyuan Power Group Corporation Limited trades at a higher price-to-earnings ratio of 11 times and a higher price-to-book ratio of 0.65 times relative within the industry. This shows that investors are pessimistic in the industry in general, and we should dive deeper on the reason. Additionally, the stock appears attractively priced, even though it is trading at a higher price to value than it appears. We will need to evaluate if the business earnings is sustainable and if the assets are valuated rationally. Overall, we need to identify if this makes a good investment on the long term, or is it going to be an extended period of low valuation or a value trap. The leverage on the balance sheet appears elevated, with liabilities of 67% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The company have a dividend yield of 6.46%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through an analysis of the wind and solar power segments. The solar power segment experienced significant growth, with a 27.41% increase in revenue, while the wind power segment saw a decline of -6.66%. However, upon closer examination, it is revealed that the wind power segment actually increased by 6.33%, driven by notable increases in installed capacity in Liaoning and Xinjiang. In contrast, the solar power segment experienced a significant decline of 21.63% due to no notable changes in installed capacity. The stability of other segments was also observed, with a slight decrease of 0.23%. Overall, these findings suggest that the growth or decline of revenue is largely driven by the performance of the wind and solar power segments. The net income of the company experienced a significant decline between 2025 and 2026, decreasing by RMB 310,292, minus 13.2%, to reach RMB 2,035,444. This downward trend is evident despite an increase in revenue or sales. A closer examination of the profit margins reveals that both operating and net profit margins have decreased over the same period. The operating profit margin dropped from 44.7% in 2025 to 41.8% in 2026, while the net profit margin declined from 28.6% to 25.1%. These decreases suggest that the company's ability to generate profits has been compromised, likely due to increased costs or reduced efficiency. The financial performance of the company varied across different regions and segments. In terms of regions, Xinjiang, Heilongjiang, Henan, and Qinghai performed well with significant increases in installed capacity. These regions saw growth rates ranging from 3.86% to a staggering 312.18%. On the other hand, Zhejiang, Shanxi, Tianjin, and Hainan struggled, experiencing decreases in installed capacity. In terms of segments, wind power and solar power generation businesses were the standout performers. The wind power segment saw a growth rate of plus 6.7%, while the solar power generation business experienced an impressive plus 33.3% increase. These results indicate that the company's focus on renewable energy sources is paying off, with significant growth in these areas. Concerns about inventory buildup or supply chain disruption are valid and evident in various sectors. The rapid growth of installed solar power capacity in Qinghai has led to a 312.18% increase, which may cause potential supply chain disruptions. This surge in demand can put pressure on the existing infrastructure, leading to delays and inefficiencies. Furthermore, operational shutdowns at critical points in the supply chain can also have significant consequences. In Ukraine, a local grid substation serving a project experienced a 100% year-on-year change due to an operational shutdown. This disruption highlights the vulnerability of supply chains to unexpected events and emphasizes the need for robust contingency planning. That concludes the financial summary for China Longyuan Power Group Corporation Limited. Feel free to comment below, and I will be happy to answer them when possible.